Good morning and welcome to this Monday, April 18th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we got futures down this morning, kind of adding on to some of the weakness we've seen of late. The more I look at the charts, the more I think we've got some more downside to go. We'll see whether or not the February low holds. Got a lot to go over today. Got a couple events coming up. Lots going on. Bank of America reported this morning. Pretty good report out of Bank of America. The banks overall have not done well, and some of the leaders in the space have even provided some disappointing numbers and guidance. So it was good to see a decent report there. But unfortunately for the bulls, there are a lot of bank reports coming out this week, and banking has not been a very strong area technically. So not really expecting a whole lot of good news there as we go forward. So that might be something that weighs on the market this week, as like I said, we do have a lot of banks reporting. Let's see, before we get going here, I want to take everyone over to our website, especially those of you that are new. Love to have you join our free Earnings Beats Digest newsletter. So if you go over to earningsbeats.com, scroll down, you'll find an area here on the left side where you can subscribe. All it takes is a name and email address, hit that subscribe button. It's a 3 times a week newsletter, very quick read, normally just a couple of paragraphs in a chart, very quick to try and get my point across on whatever it is that I want to, whatever point I'm trying to get across. We focus a lot on relative strength, earnings, gaps, candlesticks, all of those types of things. But those are really useful for those who like to trade the market. But we do a lot in terms of guidance as well, which I think will benefit those of you who are more longer term investors. So just go over to earningsbeats.com, scroll down, and you will find an area where you can sign up there. All it is, name and email address, no credit card required, completely free. You can unsubscribe at any time. We do this for our community just to kind of give back. If you're not getting something out of it and you want to unsubscribe, no problems, no hassles. You're certainly welcome to do so. We do events, though, from time to time, and when we do free ones like the one we're having today at 4:30, we reach out to our entire community, including those on the Earnings Beats Digest. So we will send room instructions out later today to both our members and to our community members at Earnings Beats Digest. So it's a great time to sign up if you haven't already. 4:30 today, going to do the Q1 earnings sneak preview. This is just an early look. Earnings have started to come out, so we'll take a look at a couple of companies that have reported really strong numbers, and then take a look ahead at what we should expect over the next couple of weeks. Are we looking at, some areas of the market that should provide some nice earnings reports? So we'll be looking at sectors, industry groups, and then a lot of individual stocks of companies coming up. And anybody, by the way, that's on our Earnings Beats Digest newsletter also gets our upcoming earnings chart lists. And these are really important. Every day, you got a number of companies that have reported since the prior day's close. So for instance, Friday after the close, nobody reports. That's just not a time when companies report their earnings. But Monday morning, this morning, we're starting to see some of the banks coming out. And then tonight, after the bell, there'll be some earnings. I know JB Hunt Transport's a trucker. That's going to be interesting with the way the truckers have been performing. But JB Hunt reports after the close. So what we do is we put together a chart list, and this week was a little bit different. We may change it later today. But right now we have all of our upcoming earnings chart lists set up so that they're just in a chart list on the day they report. Normally what we do is we take Monday morning as one chart list, and then the second chart list for the upcoming earnings for this week would include Monday afternoon earnings plus Tuesday morning earnings, so that when the market opens on Tuesday, it's a one-stop shop. You can come to this one chart list and you can see everybody that's reported since the last market close, or at least everybody with a market cap over $1 billion since the last market close will be in a chart list, and you can quickly at 9:30 see the changes that have taken place. It's a really cool chart list, and we do that as just a thank you for following us and supporting us all these years. But anyway, later today we're going to have this event, this Q1 earnings sneak preview, which is going to be pretty cool. It's just a initial analysis of quarterly earnings that have been reported so far, plus looking at the ones coming up. And I'll give you an idea. I can tell you right now, I've got jotted down already 13 companies that will be reporting this week that are leaders in their industry group. Wall Street's looking for good numbers. You need to know which companies those are. And we're going to be talking about those tonight. So, and again, it's a free event. So why wouldn't you check it out? So 4:30 tonight. If you don't know how to get in, this is, again, name and email address, all it takes. Get into the Earnings Beats Digest. We'll send you instructions later. Tomorrow, now this is a members only event, so you'd have to take out a 30-day free trial. That requires a credit card, but it's still free for 30 days. But tomorrow we have our draft for our ETFs. And if you click on this, you get our historical performance. I don't go over this much, but this last quarter has actually been a pretty good quarter for our model ETF portfolio. You can see that the S&P 500, and this quarter, by the way, runs from January 19th to April 19th. So every 90 days, we draft a number of ETFs. And when I say draft, we're selecting the ETFs and putting them into a model ETF portfolio. So we have, I think, 10 ETFs right now that are in our model ETF portfolio. And I think we have one that represents 20% of the portfolio. We have several that represent 10%. And then I think we have maybe 2 or 4 that have 5%. Anyway, obviously the total of all of them equal 100%. But over the last 3 months, the S&P 500 has been down a little over 3%. And we started in the last quarter looking to hedge, because if you know from back at the beginning of the year, I talked about this being a rough start to the year. So we did some hedging and selected a lot of ETFs that were more defensive, even have gold in there, the XME, which is a mining ETF. That's been our best performer by far. I mean, if you look at the XME, that's really helped the performance of our ETF this quarter. But we got that coming up tomorrow, and there's going to be some similar hedges. I can tell you right now, looking at what I see in the market, this is going to be a big event. And you can see just by hedging a little bit, we were able to outperform by 4 percentage points in the last 3 months. Pretty cool. And our stock performance has been okay this particular quarter. Now, this quarter runs from February 18th to May 19th. So this is a little different calendar quarter. We just don't do them all at the same time. We do our stocks one month and we do our ETFs a different month. So that'll be coming up next month. But we put 10 equal weighted stocks in each of our 4 portfolios. And the aggressive and the model portfolio both have very, very strong long-term track records. Income and strong AD, the strong accumulation distribution, not quite as much. The income is probably always going to underperform in a secular bull market. It's doing a little bit better this quarter because the market's been off a little bit. But normally it's going to probably underperform. So that one doesn't really bother me. You just have to understand, if you're getting into the income, you're definitely, well, in my opinion, most quarters you're going to be taking less risk. You're going to be going into more dividend-oriented companies. And so you're not going to get the capital appreciation that you're going to get in a lot of stocks during a secular bull market. So the income is normally going to, I would say, typically is going to underperform somewhat. But strong AD had one or two really bad quarters relating to growth stocks when the growth stocks went out of favor. This was actually a leader for us as well for a while. I expect it to come back with a return to the bull market probably later this year. But anyway, these will be up next month. All right, let's quickly go through what happened on Friday. We had the Dow Jones Industrial Average down 113 points, the S&P 500 down 54, NASDAQ down 292, mid caps down 15, small caps down 8. On a percentage basis, again, the NASDAQ getting hit the hardest, down over 2%. You can see all of its action now taking place below both the 20 and the 50-day moving average. You can see the Dow and the S&P are doing more straddling around that moving average. The mid caps, small caps also mostly below the moving averages over the past week or two. From a sector perspective, energy and utilities, two leaders. Again, we've seen that a lot over the course of 2022. Energy especially been very strong. Materials have been strong. Utilities, healthcare, real estate. Those are the key area, or the key defensive areas, along with, of course, energy and materials, which I consider to be more neutral. The aggressive groups, though, you can take a look at what happened on Friday. This has been typical. I'm going to show you in just a minute how typical it's been. But technology down 2.4%, communication services 1.7%, discretionary 1.4%. If you want to know why NASDAQ is performing so poorly, it's because these three aggressive groups are not performing well, and these three groups are more heavily represented on the NASDAQ than they are on the other major indices. So as long as these three groups stay weak, the NASDAQ is going to struggle. Well, the whole market's going to struggle. There's just not enough representation in the S&P 500 by energy and by materials and by utilities and by real estate to carry the entire index. The index needs the support of these aggressive groups, and it's just not getting it right now. 10-year Treasury yield. So let's talk a little bit about the economic reports coming out, because this week we've got today, April housing market index. March was 79. We're expected to see it drop to 78. Tomorrow we have March housing starts. February was 1.77 million units, and we're expecting that to drop to 1.75 million, 1.77 to 1.75. March building permits also out tomorrow. February was 1.86 million units. March is expected to drop 1.83 million. And then Wednesday, we've got March existing home sales. February, 6.02 million units, expected to drop to 5.86 million units. Now, again, we're talking about, with today, April housing market index, but tomorrow and Wednesday, we're talking about March housing reports that are expected to drop. We're now halfway through April, and you know what's been going on with the 10-year Treasury yield right here. I mean, this is not going to be good news for home builders in the short term. The good news is, I think eventually the 10-year Treasury yield's topping and coming back down, and probably go back down to 2%, maybe even below. And I think that'll be great for home builders. And I think it'll be great for banks. I think it'll be great for the truckers, all these areas that have been getting hit hard. I think that will be good news down the road, but we got to get there. And so this bridge to take us from here to there is what's going to be so choppy and dicey and difficult and cautious and so forth. And I wish we could just, leap over this period of weakness and jump into the secular bull market advance, but the market doesn't work that way. So we have to do our best to protect our capital until we get there. Maybe make money along the way, but you're going to have to be very selective. You're going to have to go with what works, which right now is a lot of defensive groups. But anyway, I wanted to point out these housing reports, because the next 3 days, the only economic reports coming out are about housing. And we know it's not going to be good news. There's nothing probably in this that's going to be good. So the market is going to have to deal with bad news from an economic standpoint. It's going to have to deal with earnings. And I didn't add up how many of the earnings there are. I have 135 companies on our upcoming earnings relative strength chart list, which comes out once a week, by the way. And all that chart list does is shows every stock on there relative to its peer group. So it's the entire chart list is all about relative strength. Really cool chart list, because you can sort it in summary form to find out which companies are showing the most relative strength over whatever period you want to look at. Could be the last day, could be the last week, month, 3 months, year to date, whatever. So it's a great chart list at looking at what's coming up this week. So there are 135 companies on there, and I don't know how many, but I bet probably 20% of them are banks. So you've got a lot of these economic reports coming out in the home construction area, and then you've got a lot of earnings reports coming out in the bank area. And let me just show you what these two groups look like right now. Here's the home construction index since the beginning of the year. It looks like a ski slope going down, just keeps going to new lows. All right, if that's not enough excitement for you, let's take a look at the banks. A little bit more choppiness, but basically the same thing since early in the year. It's going down to new lows. 52-week low on the bank index right now. 52-week low. Stock market's not at a 52-week low. The S&P 500 still up here. I mean, we got this low way down here at 4,050. So we're still 350 points above the 52-week low on the S&P 500, yet the bank index is at a new low. So that tells you right there, relative strength. Banks don't have it. They've got relative weakness. Not good, because again, that's what we're going to get a lot of reports from this week. So what I see coming up this week is just bad news. I mean, we've got some good earnings reports. Like I said, there were 13 of them that I pointed out earlier that I think look pretty good. One of them I'll just give you was in our EB Digest this morning. That's Halliburton. I mean, Halliburton, if we pull this chart up, look at the AD line. I would say that that is a sign of accumulation. Well, also a sign of accumulation are the volume trends of Halliburton. As we've gone up, look at the volume that's been supporting these moves to the upside. And when you've got a rising AD line, you know, for the most part, you're finishing pretty strong in the afternoon. That's a sign of accumulation. Look at the relative strength. So it's in a great group, the oil services area, very strong group. The group, here's the group relative to the S&P 500. So it's a leader. And then you come down here and you are up here and you look at Halliburton relative to its peer group, relative to the oil services group. Very strong. Halliburton reports its results tomorrow. Now, here's the kicker though. Not always, I mean, I think we're going to have a very strong report, but that doesn't always mean we're going to go higher with the report. So I'm not suggesting you just jump in because Halliburton's going to have a great report. There's this thing in the market called buy on rumor, sell on news. And I can tell you there's been a lot of buying on rumor. So once the news comes out, we might see an initial gap up, but look at the negative divergence here. Lower PPO, higher price. So they're slowing momentum. What I would be really careful with on Halliburton would be a gap up and a failure to sustain it. In other words, a gap up and then maybe a bearish engulfing candle. Something like that, that reversing candle with a negative divergence, buy on rumor, sell on news, could take Halliburton back down to maybe the 50-day, somewhere in the 34 to 36 range, I think is possible. Now, I love Halliburton, and I'm not saying it's going to go there. I'm just saying if we come out, if the company comes out with great results and we get that sell on news and we do go down into that area, 36, I mean, once it hits 36, I would begin to buy the stock. I would be accumulating. And I'd probably be looking down to 34. I mean, that was where we made this breakout right here. Big volume beginning of March, went back, tested 34 and held. So maybe we go back down to 34 again. But even at 36, that 50-day, I think I'd start accumulating. That's just my own personal preference. You could, have to make your own decisions, decide what you want to do. This stock may not come back down. Maybe it gaps up and just keeps going higher. Negative divergence doesn't guarantee us anything. It's just alerting us to be cautious that it could happen. We could see some selling in the near term. But my takeaway from this is that Halliburton is a very, very strong company heading into its earnings report. And the only reason that you see this is Wall Street's been meeting with these companies. They see, they talk to management. They find out, okay, how are sales going? How are you doing relative to your competitors? What's your advantage? Blah, blah, blah. Of course, crude oil prices have been high, much, much higher. That's going to add to the profitability. A lot of positives that Wall Street is seeing in Halliburton. And so this is one of those 13 companies that I'm talking about that I'm going to be discussing later today. Many others, some in energy, some outside of energy, a couple in healthcare. I think there's some really, and it actually is one in consumer discretionary that I'm looking at off the top of my head. I'm looking to see if there are any others. I'm just seeing one. But yeah, I mean, there's some leaders that I think you need to be aware of that will be reporting later this week. All right, so I talked about defensive groups earlier, and I said I'd show you, the fact that the three worst groups, consumer discretionary, communication services, and technology, those are down at the bottom. But this is on an intraday basis, so this is just from Friday. What about over the last week? What's been going on? Well, energy and materials led last week. There you've got consumer staples, you got utilities, real estate, there's healthcare. So those are the defensive groups. Among the aggressive groups, you've got industrials that held up pretty well last week, but the rest of them, you've got consumer discretionary, financials, communication services, and there's technology down the bottom over the last week. Look at technology, lost 5% last week. So the S&P 500 was down 2%, but you can see how rapidly technology is losing relative strength, down 5% last week. Wall Street is not moving into that aggressive area. This is not a risk-on environment. And as long as it remains risk-off, you want to be cautious. Look at the last month. Consumer staples, defensive group leading over the last month, up 10%. Materials. Now, consumer discretionaries had a pretty good run, but it still trails consumer staples. Still, you've got that relationship between staples over discretionary, and I don't like that. Then you got utilities, energy, real estate, healthcare. Where are the other aggressive groups over the last month? Oh, here they are. Communication services, technology, industrials, financials, all lagging over the last month. How about the last 3 months? Energy and utilities, really strong. Healthcare, green. Consumer staples, green. Real estate, green. Materials, green. And then we get into the red. Oh, that's the 5 aggressive groups, all red. Technology, 11%. Communication services, 13%. Financials. Can you see the rotation that's taking place, that's been taking place? I talked about this. This is over the last 3 months. So this only goes back to January 15th. I wrote an article about it at the end of December. That money was rotating into defense. And this chart is telling us that it's continuing. Nothing has changed. So if you're looking for this to be a 2 or 3 month, pullback and then right back up we go, this is arguing against that. This is still telling us that Wall Street is avoiding the aggressive areas. They're avoiding risk, getting out of anything risky. Not good. And then year to date, of course, that's just a little bit more than 3 months. That's 3.5 months. Look at energy, 45%. I mean, it's been a huge run for energy. Utilities, 7, staples, 2. So my point is, if you're going to trade on the long side, you cannot look at the market the same way. I see a lot of folks saying, well, I get emails in and, I'll get questions that come in something like, well, AMD, Advanced Micro is $130. Now it's 100, isn't that a great deal now? Well, it's better than buying it at 130, but it doesn't tell you it's not going to go to 80. If Wall Street's not buying it at 100, I don't want to buy it at 100. I want to wait until it starts to show relative strength. It's not showing it right now. Anyway, let's move on here. So here's your S&P 500. This is the weekly chart. Now we went down, put in potentially a left shoulder, came back up, potentially a neckline, 4,600, put in a lower low, potentially an inverse head, back up to 4,600. There's your right side of your neckline. And now we're coming back down, potentially into a right shoulder. Left shoulder was 4,200. Maybe we get to 4,200 and boom, back to the upside. That's a possibility. That's certainly, looking at this pattern, it's a pattern that if it executes, would be very bullish, but it has to execute. I can't tell you over the last 10 years how many times I've seen technicians point out topping head and shoulder patterns that never executed. You don't get bearish because you see the potential of a bearish pattern. You get bearish when you see the breakdown in the execution of a bearish pattern, unless you have other signals. Obviously, like we saw back at the end of December, there were already a lot of bearish signals lining up. My point here is that you don't expect bullish outcomes out of a pattern just because you see the pattern. It's got to execute. Now, if I had not seen all the warning signs and the sentiment wasn't a problem and we didn't have a lot of issues, I would absolutely be looking at this as a bullish pattern. I would be expecting everything to resolve bullishly if I didn't have other warning signs, but I do have those other warning signs. And so I'm not expecting this to execute. I actually think we're going to go back down and test this 4,100 area, and then we'll see what happens from there. Now, things can change. Technicals change. As technicians, we have to change with them. But right now, I don't see really a whole lot that's changed from back at the beginning of the year. I still think we have sentiment issues. I still think we have issues with money rotating into defense. I still have issues with the way the growth stocks are performing versus value. I mean, there's still a lot of issues in the market that have to be resolved, or we just simply have to go lower to the point where Wall Street's willing to put more money into the aggressive areas. And we need to start seeing that relative strength. And that is not there right now. All right, one company that reported earnings last week, a blowout. UNH, they beat top line, they beat bottom line. Everything looked good on their report. Look at their AD line. The AD line prior to the report was at a 52-week high. So accumulation distribution looked good. The breakout just recently, we had sideways consolidation. We broke out heading into the earnings report in a market that's been breaking down. That's good news. So you got a relative leader. And when you look at the relative strength down here, healthcare providers relative to the S&P 500, we're right now at an all-time high, or at least a 52-week high, relative high. UNH relative to the healthcare providers is a leader. So here's the evidence of a leading stock in a leading industry group being accumulated and having a breakout. Now, here was the reaction to the earnings report. This is why I was talking about Halliburton earlier. UNH gets this great news, was what, 536, 537, was up $15 and breaking out intraday. Look at the reversal. So I think UNH could come back down, get a 20-day test. I think 520 might come into play here. And if it does, you got a leading stock and a leading industry group testing a key moving average. Great time to enter, as far as I'm concerned. So if United Health's a little weak to start this week, we might have an opportunity for a trade there. And so Halliburton, just be aware, they report tomorrow, but don't be shocked. Buy on rumor, sell on news. All right, relative strength of sectors. This is another way to look at it. I was showing you the sector summary. Well, here's a chart list of each of the 11 sectors relative to the S&P 500. So we could pull the chart up, and there's energy on a relative basis. You can see what it's doing relative to the S&P 500. I'll be honest, it's much stronger than I thought it was going to be. Now, of course, I never saw crude oil prices going up to $130 a barrel. I didn't know we were going to have the war between Russia and Ukraine. So obviously there's some things from a technical standpoint that are not going to show up on the chart. But now that we have those things, you can see the strength in energy. So pullbacks in energy close to a key support level makes sense to me. If you break your support level, you get out, you take a small loss. But if they hold and they continue to show relative strength, then you can make money even in a downtrending market because energy is uptrending relative to the market. All right, so let's go back here. Down the bottom, look at what's trailing year to date. Technology, 8 percentage points below the S&P 500. So here's the reason why the S&P can't get going. Wall Street doesn't want these three groups. The three aggressive groups, Wall Street wants nothing to do with them. All the other groups, 8 out of 11 groups right now are outperforming the S&P 500, and yet the S&P 500 can't go higher. Why? Because these three groups on the bottom are so heavily represented in the S&P. When they're going down, it's the 800-pound gorilla, 3 of them, all pulling the S&P 500 with them. So it's just these 3 groups right now that we really want to stay away from. Although financials, industrials, I mean, those areas also have a lot of weakness as well. Stick with what's working, defensive groups, until things change. If you're going to trade on the long side, if you're going to trade on the short side, then yeah, these 3 make perfect sense. Get bounces in those groups near the 20-day, probably a good time to take note, maybe go short. Then the industry groups, we got a relative strength industry group chart list, has all 104 industry groups on here. This is a year to date. Look at all the energy and materials groups that are all lining the top of this. Here is the non-ferrous metals, just recently breaking out to a new relative high. So anyway, wanted to show those two. Earnings out this morning. I know it's 9:30. We'll wrap this thing up here in just a second. Actually, tell you what, let's look at 3 earnings reports coming up today, or that came out today. We'll look at their charts, and these will be your 3 you must see. So first up, Bank of America. Let's get a update. So we get today's open in here. Oh, this was showing actually earlier. Bank of America was actually showing up almost 1% pre-market. They did beat 80 cents versus 76 cents. And the stock was up pre-market, but you can see, I mean, it's just the overriding bearishness in this group right now that is making it difficult. Here's the bank index, 498, under 500 now, setting another low. Bank of America, even though it had good numbers coming out, down slightly, down about 0.5%. See if it's doing anything else real quick. And down 2/3 now. Schwab reported, although I didn't see their bottom line. Obviously, Wall Street didn't like it. Schwab down almost 9%. Needs to hold this low right here. I think today is going to be a big day for Schwab. If it closes below 75, I think it's probably heading back down here into the upper 60s. If it can hold 75 intraday, if it goes down below and comes back up, prints like a hammer, something like that on support, you could take a shot for a near-term bounce. Maybe you can get it back up to 80, but still overall not great. I don't like the fact that we've got the AD line. See how we're at equal price right now, but the AD line is lower, starting to show more of a downward slant. Look at all the volume that's been coming in during this period. It looks like a lot of distribution, especially if we get the breakdown. When we look at relative strength, look at Schwab's relative strength versus investment services. It was a month ago near a high, and now all of a sudden falling apart. This is a change of character on the chart here for Schwab, so be careful. SYF, this was a big beat on the bottom line. This will be the last one. So this is Synchrony Financial, $1.73 versus $1.53 expected. So really good report going up. I honestly, knowing what and what I've seen at the banks, I would be a seller at the 50-day. I just don't want banks right now. They're not performing well overall. The chances of having one that's going to just take off and go higher, especially when you look at the relative strength. This is a stock that was performing very poorly until just the last couple of weeks. We got a good report. We've now gotten to the 50-day. We have this double bottom in play. I think we're going to fail. I think this is going to roll back over and go to the downside. So yeah, it's having a nice day so far, up 3%. I'll be surprised if it holds. We'll see by the end of the day. All right, let's take a quick look at the overall market. Oh, big bounce back here. I'm kind of surprised, but Dow Jones up 100, S&P up 5, NASDAQ up 5, NASDAQ 100 up 23. So we're seeing a little bit of strength here. That's good news. Looking at the S&P 500 leaders, there's your SYF leading right now, 3%. And on the downside, there's Schwab leading, down 7.5%. So anyhow, just want to wish everybody a good day. Again, later today, 4:30 Eastern, Q1 earnings. This is a sneak preview. I'm going to be giving out the 13 companies. Actually, I'll be doing more research, so there might be more than I'll give. But I've already jotted down 13 companies I'm going to be talking about later today. I'm going to be looking at the sector relative strength, the industry group relative strength, tell you some of the areas where I think we could see some good reports coming out. Usually, earnings season, we have themes. And if you catch them early, you can use them to make some money. For instance, last month or last quarter, it was all about energy. Energy from the opening bell after earnings reports, energy companies were being bought. We were seeing a lot of accumulation. So that's one thing we'll be looking at here early in earnings season, trying to get a feel for what areas of the market are standing out in terms of earnings reports, not just the reports, but also how Wall Street is reacting to the reports. Dow now up 135, S&P 9, NASDAQ 8. All right, that's it for me. Tomorrow, you can join me over at Stock Charts TV. Just go here at 9 a.m. and click on Stock Charts TV, and you'll be able to come in and listen to my next episode of Trading Places Live. And then, of course, I'll be back here on Wednesday at Earnings Beats. Have a great day, everybody. Happy trading.